we will start the next discussion on China's economic outlook, where we are honored to have three distinguished speakers. To start with, we will have Ms. Dan Wang, ex-chief economist from Hang Seng Bank. Later on, we'll also have a presentation online from Ms. Alicia García-Herrero, the chief economist for Asia Pacific for Natixis. Alicia was here at our Understanding China conference last year, but this year, unfortunately, she's only connecting online. Last but not least, we'll also have Jacob Gunter, the lead analyst economy at Merix. Without further ado, I would already invite Dan to the floor. Dan, the floor is yours. Thank you.
Right, good morning. It's my great pleasure to be here and share with you my understanding of where China is now. As Liam has introduced, I have recently left Hang Seng Bank for forces beyond my control. And that is a new change since the third plenum, which we can come back to later. But to understand China now, it is very difficult because essentially the policy discussion in the public platform has stopped. There are authorized personnel, of course, in mainland China, including myself, for a long time, that we can have an openly honest discussion about the policy implication. But clearly, the recent changes in the economy has caused some cautions from the central government because there can be only one message. And that message is that we're in this deep transition from the traditional engine-powered economy to this new engine-powered economy. And traditional engine included housing, included infrastructure, and partly included consumption. But this new engine is majorly centering around this high-quality productive forces, which is essentially the high-tech, the upper stream of the upper end of the supply chain, and a massive state-backed model to develop high-tech. So during this transition, a few things have already happened, and it will be strengthened. One thing is that the policy has been so focused on developing the manufacturing capacity. But as we know it, manufacturing doesn't generate enough jobs for the domestic economy. It generates some jobs, but it's not as much as the services sector or the consumer sector, and that's a fact. So over time, the government has to be able to retrain its workers to redesign the college education in order to cater this new economy. But in this transition, nobody is comfortable. And then there's also a problem about how to resolve the local government debt. Because the central government clearly is in a very good fiscal condition. Comparing to the situation in emerging markets, in the US, in Europe, Chinese government is actually, central government, is actually in a very healthy fiscal condition. But then we worry about the local governments, because over the past 30 years, for China development model, it's essentially relying on this over-leveraging model from the local government. They not only borrow from their own account, they also borrow through the local state-owned enterprises, that's what we call the LGFVs, to borrow for them from the commercial markets. That's basically Chinese banks. So currently, there are more than 4,000 banks in China, and more than 95% of them are smaller regional banks that are highly exposed to local government debt and also to the housing market. So this is a very peculiar moment, and of course, it's understandable. The government wants to make sure that this transition can go smoothly. And before I start my discussion about the current stimulus and the status, I also want to provide one data point about this big background, bigger picture of the Chinese economy. Because people often consider China's economy's sort of like a decline or recessionary stage started with COVID, but it was not true. China's turning point was 2022. And it was purely because of the housing market. I know that COVID control or the zero COVID policy had added more woes to Chinese economy, but the real trigger was this induced policy change in the housing sector. So by the end of 2021, the Chinese central government decided that they cannot let the housing bubble to go up any further, because if there is a possibility for financial crisis, it's going to be one way or another linked with the housing sector. So they required the real estate developers to cut their debt exposure to the banks by a large amount within 2 years. And that's a very drastic plan. And simultaneously, all the Chinese commercial banks were also required to cut their exposure in the housing market by a substantial amount. Their exposure was usually around 50%. That's their asset exposure to housing. So normally, depending on the size, they're required to cut down that exposure also within 2 to 3 years to 20 to 15%. So this amount of reduction in leverage means that the liquidity in this sector has quickly dissipated. So housing is the number one pillar industry for China in the past 30 years. If we account the upstream, the downstream, the housing sector's contribution to GDP, and we probably all heard that number, it's 30%. But now, it's way less than that, depending on which estimate you look at. Now it's about half that amount. But we cannot create a new sector strong enough to replace that. But from 2022, it's quite clear that every single year, on average, the housing investment, I'm just talking about investment, not related consumption, housing investment has been coming down by about 2 trillion RMB per year. But simultaneously, the manufacturing investment was going up by more than 2 trillion RMB per year. So when you look at the headline figures for China's macroeconomy, it doesn't look so horrible. Actually, it can still sustain a growth around 5%. And I wouldn't go so far as to, like, Chinese government is massaging this data so much that can give us this result. Actually, because I talk to the business owners, I visit the manufacturers in Yangtze River Delta and the Greater Bay Area very regular. That's actually my main job when I was with Hang Seng Bank. So it's clear that their investment has been sustained in manufacturing. So this is a fact. I have no doubt that it is not that difficult for the Chinese government to achieve their economic target. It is just that it wouldn't be really translated into individuals' income or the social welfare improvement in the short term. It will be more translated into this manufacturing investment, this innovation, or whatever subsidies to the companies, not to consumers, to companies. So that has brought us to this that's mine. To this latest change in the government's approach to the economic problem, because for the longest time since COVID, the job for macro forecasters like me have been very difficult because it's hard to pin down what the policy response would be. There's clearly a lack of policy response from all levels of government. And I've been following Chinese economy for more than 10 years now. It was quite clear before 2020 what the government would do. So you actually knew exactly what it would do. So if there is a sharp, say, slowdown in the housing market, immediately there will be a rate cut. And there will be some sort of relaxation on the purchasing restriction, or there will be some sort of targeted program for the government to build more homes. But this time, since 2020, this hasn't been the case. So the intention to curb this housing bubble is pretty clear. And then when it comes to the capital market, it was even harder to follow because now China has the biggest bond market bubble in the world. But simultaneously, the stock market is still quite volatile. Right before the Golden Week holiday, that is the first week October, then there was this sudden policy shift, which I'm sure you have all heard of it. And that change of approach is quite peculiar. Because Chinese government normally don't do this. They normally would start from the real economy rather than the capital market. But this time, all those liquidity were injected into the stock market and commercial bank. And for commercial banks, ultimately, those credit were expected to be converted also into money into the capital market. So there are several reasons for this. One immediate reason, of course, everybody talk about it. It's right before the 75th anniversary for the party, and of course, happy birthday, the party. And there has to be some sort of preparation in that direction. And then I don't think that's the key, but clearly it is a trigger why this kind of meeting can happen in September. Because Politburo meeting usually happen in October, and it's usually not about economy, but this time it was arranged ahead of schedule, and it was all about economy, and it's about boosting the capital market. It's peculiar. And then the second reason why I think it happened was a series of bad headline figures, including the unemployment rate. So the unemployment rate for China as a whole is not bad at all, but it has a lot to do with the definition of unemployment. So if you work for 1 hour per week, even without being paid, then you're employed, right? So the headline figure now is about 5%, 5.2%, very healthy. But the job condition has deteriorated. The enrollment in Social Security has declined. Many of those workers are either part-time or full-time without any social safety net. And last year was actually the first year that the enrollment in medical care and Social Security declined. For the 20 years before that, it always increased. And then the third reason, I think, is also because the Federal Reserve has cut interest rate. Certainly, people talk about that being a causal factor for Chinese decision to relax its money. But I don't think that's really that. Even without the Fed cutting the rates, this kind of discussion about relaxing the monetary stances has been there for a long time. And the Central Bank of China, they didn't have much independence to start with. And at this point, we probably are looking at the weakest central bank in China's history with this new leader, the Pan Hangzhang. So he's a great scholar, a great practitioner. But his room to maneuver in the monetary area is way less than Zhou Xiaochuan or Yi Gang. So he has been quite reluctant to really cut rates or ease the money because there is no intention for the government to blow up this housing bubble again. So the general condition happening in China's history is that as soon as you cut interest rate by a large amount, one way or another, that money will find its way back to the housing market. But this time, through this careful channeling, the money was successfully channeled through to the stock market. And I think that brings us to the fourth point, why I think it happens this way, is to give those high-tech industry, those listed companies, a way out. Because China wants to finance its high-tech sector. And the savings rate in China has been so high. Right now, it's 45% of the GDP, probably the highest in the world among large economies. And those money now just sitting in the bank. And for every single commercial bank, it's extremely difficult for them to find a borrower. And at this point, the only one that's willing to borrow are the ones that don't lack money, that don't need money. The SOEs, the large POEs, or some of the SMEs. So for those small micro borrowers, they have been having this pretty good access to commercial banks in the past 2-3 years. But still, the real borrowing rates are quite high. It's usually between 8 to 10%. And in contrast to that, see, if you're an SOE, you can usually borrow at a rate of 2% or even lower. If somehow you're so lucky to be included in the sanction list from the US Treasury, then immediately you can almost borrow for free. So that's a case for Huawei, for several other companies. And we can see that being this a driving force for this more unequal access to the financial market. But this time, see, like the Beijing Stock Exchange that's targeting the high-tech industry, that's what we call like the little giants, smaller in size, but still quite successful in getting a large share in certain segments in manufacturing. And also the star market, the startups. So they're all getting a boost from this round of stimulus. And I think this this positive effect in the financial market will sustain at least throughout the rest of this year. We only have 2 months left. The intention is quite clear. They would like the financial market to stay strong and hoping that this dog would wag its tail, like the tail can wag so strong it can eventually wreck the body. You know, the real economy is a dog body. And this is a very peculiar approach. And another shift in this new stimulus is in the mindset of subsidizing consumers versus the corporates. So there is still no stimulus for the general consumers, but there are talks about giving money to family with more than one child, right? If you had one child in China, your child is basically qualified for this about $100 per month until the kid was 18. And in some areas, this could be like 14 or even younger, but normally you can get that money for a very long time. But it doesn't apply for the second child or the third child. And now the new policy is saying, like, every child, you get $100 per kid per month until, I don't know which year, depending on the region, but at least 3 years old or 5 years old or even 7 or later. So that's quite substantial for a typical family in an average Chinese city. So if this happens, it can have a moderate boost for a small fraction of the Chinese population, because you know people are really not keen on getting married, having babies. They're postponing their family planning because the future is very uncertain. But whatever the case, this stimulus marked a pretty significant shift in the mindset of the central regulators and policymakers. And the right-hand side, we have this chart on the GDP target and reality. The target are those blue dots. So what I want to show on this chart is that these targets are acting as a market confidence lifter. It's the policy intention. And in most time in China's history, they were not just achieved, they were exceeded, big time exceeded. There are only a few years that we had those marks lower, the actual growth lower than those blue dots, the target. And there are usually some very peculiar conditions, like the 2014 when we had this unsuccessful of the liberalization of the financial market, and then during COVID, of course, it happened. And this year, the target 5%, I think we might miss it by a small amount. So now my forecast is still like 4.9%, not too far off. Then the question is, could these policies impact sustain and have the fundamentals improved? The biggest fundamental for Chinese economy in the short term is housing. That is the factor. So we can talk about all the other investment, consumers, they don't decide the economy. If we're looking at a turning point for the Chinese economy, just look at the housing price and what housing market is doing. So I want to point out one line, that is the red line, way at the bottom. So this chart shows the home sales in the top 30 major cities. That's where most the home transaction happen on 7-day moving average. So from top to bottom, 2021, 2022, 2023, 2024 by month. So far, 2024 is the worst in performance of a housing transaction. Oh, thank you so much. In the housing transaction. So that just means we had several rounds of housing stimulus this year and last year. But regardless of the housing stimulus, the transaction has been going down. Yeah, 2021 was the peak, 22 crashed, and then down and down. So whatever housing stimulus there were, they all failed. So, or their impact had dissipated. Maybe it had boosted the housing transaction in certain cities for a very short period of time, but it's like a one-time boost, and then stop, boost, stop. And now there's no boost. So we basically have no restrictions now on borrowing from the bank or on what kind of people are qualifying to buy certain type of housing in certain cities. No such restrictions anymore, but it's not rebounding. And the market a consensus is that we're still not at the bottom yet, which I'm very much agree with. So my forecast right now is that the housing market probably will reach a bottom. This is the most optimistic scenario. I don't want to scare you with the darkest scenario. So the optimistic scenario, by the end of next year, the housing market will reach a bottom, not bouncing back, but reach a bottom, maybe stabilize in terms of housing price. So that is calculated based on the blunt supply and demand, because people have been postponing their purchase of new homes for the past 3 years. Yeah, even if they're not getting married, they're not having babies, there's still people getting married, having babies. They do have some robust demand, and people are still migrating between cities. And normally, if you want to get married, the mother-in-law would require a unit of housing. So it is a fact. It's not something I go against with. So there is some demand, and people are waiting long enough. So next year, I'm just making this blunt assumption, by the end, reaching the bottom. And that means by 2026, we probably will see a general improvement in the Chinese economy. That recovery may not be as rosy as what people are hoping for, because, again, this long-term strategy, as lined out by the third plenum, is all about a transition towards a high-tech economy. And that means within this economy, the resources are dumped into high-tech, dumped into manufacturing. It's not really targeting the consumer sector. And on the right-hand side, I draw this line for primary school enrollment. So we talk about robust demand in China and the aging population and demographic changes. These are the long-term deciding factor. So when it comes to robust demand, the most robust demand is coming from those children that are enrolled in primary school. That's when a family decides to exchange, replace their older, smaller housing with a newer one, or if they didn't buy one, they will buy one at this point. So this is very robust. And those children were born. So we have no problem calculating every year how many kids will be enrolled in school. So we only need to look at this, because this is a projection, this blue one. So from now to 2029, every year we'll have a 10% decline in primary school enrollment. I think that is the most important leading indicator for the robust demand in Chinese residential home market. So this just means maybe we reach a bottom. There's no way we're gonna see the bouncing back. There's one scenario that we might see actually another round of prosperous construction in housing. That's when there is this massive replacement program. So now the government doesn't want to talk about it, but in many of the closed-door meetings they do. The average lifespan of Chinese tower building, we don't have those standalone mansions that much, it's tower building. Usually the lifespan is 25 years, and most of those housing were built around 2000, so they're approaching the end. And at some point, many of those housing need to be torn apart or bombed or something, and new homes need to be built. So by then, there will be new constructions and new demand. But before then, not much. And here, this table is a comparison of the last 3 bailouts in housing. The biggest 3 bailouts. One is in 2008, one is 2014, one is 2024. What I want to draw your attention to is this drastic difference in base effect. So the base is very different. The average living space in 2008 was 15 square meters. In 2024, it was 42. Truth be told, this 42 is hugely inflated, because Chinese calculation of the average living space will include elevator areas, the common parks. So usually you take a quarter of deduction. So it's not 42 yet. If it's 42, it's nice. But that also means there's some improvement in new demand for housing. So it's both sides. But still, the basic fact is different. And the population growth rate, 2008, 5.1%, 2024 is 0.3%. So India has overtaken China already. Household leverage ratio, in 2008, 19%, and now it's 64%. It was like a massive increase in household leverage, mostly to buy new homes. But now it has reached this high level. Still, comparing to the American level, the European level is still low, but it has increased too fast. So now the households are too afraid to spend, also because many of them are heavily in debt in mortgage. And urbanization rate, 2008, 33%. Now we're doubling that amount. So the ultimate goal for many of the Chinese cities is 90%. So it's not official in any of the document, but if you talk to any official, they will tell you they want 90%. But that is extremely difficult. So from now to 90%, like how many more people can you move from the countryside to the cities? Like through centralized living, maybe you can put somebody in the city, but those rural homes, they no longer have the kind of fiscal capacity to support them buy a new piece of property in the city. So that room of improvement, there's some, but limited. And the GDP growth rate, 2008, we're still in almost a double-digit range, 9.7%, but now it's less than 5%. But if President Xi is serious about the 2035 goal, which I think he is, then that means China has to guarantee a 4.7% of growth nominally from now to then. And could it be achieved? It could. In some scenarios, it can even be exceeded. But there are some strong assumptions. One is that China's housing market doesn't just stay in a depressive state like Japan in the 90s. So that's one. And two, the European market doesn't shut its door to China. This is a very strong assumption. Every entrepreneur I talked to in the past 2 years, because we only deal with the top manufacturers in China, they all have a European strategy. So the bet is so high. They know they cannot get into US. That ship has long sailed. The US-China competition is going to be a long-term thing. But as long as the European market is open, they're fine. But that bet, I'm not sure how true that is. And then the housing market value. 2008, it was 10 trillion RMB. 2024, it's 450 trillion RMB. Just think about the household wealth embedded in that market. Because for Chinese families, they don't have alternative investment vehicles. They only have housing. 80% of the household wealth is embedded in housing, 80. And for stock market, it gets so much attention, less than 1% of the household wealth is in stocks. So if housing market doesn't revive, then we can't really discuss a revival in the consumer market. And this is the last chart I want to show you. The message is quite straightforward. So there are 6 pillar industries in China. The number 1, property and construction. Number 2, metals and minerals. Number 3, fuel and chemical. Number 4, electronics. Number 5, machinery. Number 6, auto. So there has to be a new engine replacing property. This green bar is its contribution to GDP, and this yellow bar is the growth rate of this sector. So that yellow bar for property and construction in 2023, because that's the final data. Every year, China published preliminary and final. So if we're looking at the preliminary data this year, we have the first 3 quarters. The first 3 quarters, this sector's growth was 0. It was 0. Last year it was still positive, but this year it's 0. So it's like no more contribution from this sector. And then what's replacing it is auto. So auto's total GDP contribution is low. Right now, if you combine the whole new energy supply chain, like the battery, the mineral mining, and the eventual consumption, and the EV factor, everything, that's a bit more than 5% of the GDP. But the growth has been double-digit for the past 3 years, and it's expected to grow by double-digit in the coming however number of years. So this is expected to be the new growth engine. And then lastly, Chinese consumer confidence. This is the ultimate constraint for the current policy making, because it doesn't matter what kind of policy will come out. The consumer confidence crashed after the Shanghai lockdown. So there are a lot of debate why that's the case. I was in Shanghai during that lockdown. So the biggest change in people's mentality, of course, there was a lot of anger, a lot of fear. It's about this unpredictability and insecurity about one's wealth. So the money, it's not just you cannot move your money out, you cannot move yourself out. So the cross-border flow of capital and human doesn't matter how much money you have, is in question. So the lowest consumer confidence is in job market, is employment. So it still is going down. And the government is simultaneously pushing forward artificial intelligence, and that would create new problems in the job market. In the short term, we will have to wait and see what the government will do with it. But the bigger picture is that the job market situation will be more severe than before. All right, I'll stop here. Thank you very much.
Thank you very much, Dan, for your sharing. Later, we'll have the chance for question and answer session. Moving forward, we'll have our second speaker, Alicia, joining online.
I'm going to be very brief because I hear my voice twice and it's pretty hard. But I want to say that after presentation of the Chinese economy, I'm going to focus on what it means to Europe. We've heard already quite a lot. Before I even start the slide, I just want to say two things. The first is that China's stimulus now, independently on the size, which we will know next week, will not be as enticing for the rest of the world in terms of European export or all of that as in 2008, by no means. So let's not wait for Godot because it's not going to come. Independently of that. Why? Because this stimulus is built upon a huge amount of debt. China's response to additional debt is no longer the same. On top of that, the money is going to be spent to clean up the banks, the unfinished housing units, and the hidden debt of the local government. When you clean up, you're not necessarily making new growth. You're just kind of cleaning up, which is good. But it is not the impact. That's first. Second, while I agree in principle that the real estate sector is crucial to understand China's deceleration and cyclical deceleration, it's not the only thing happening. The second point is that China's problems do not stop in the real estate. I want to point loud and clear. China's main reason for structural deceleration is plummeting productivity. Total factor productivity, labor productivity, and return on assets. This is what's happening in China, partially because of the real estate, but not only. And in this second point, I would end by saying that China's push for manufacturing, which we are very scared of in Europe, could end up being another bubble, same as the real estate bubble. In fact, there is already reports and kind of evidence on whether the green tech fixed asset investment will stop fully by 2027 because excess capacity. So, the problem of the real estate is an example, if I may say so, of how China builds or concentrates in excess in a single sector. It's not just that sector. It is a huge sector, and I understand that this is why we've been talking about it, but I just want to say it's a model that gets replicated beyond the real estate sector. And therefore, the problem with the real estate versus the manufacturing bubble is that the real estate bubble had positive consequences for the world. Imports of iron ore, imports of cement, imports of steel. Well, steel, not really, because China managed to produce whole steel in the world. But point is, some inputs to production, to real estate housing construction. For the manufacturing bubble, all of that is gone because China has substituted most imports. So the new bubble is worse for the world than the old bubble, but they're both bubbles. Thus, it's a question of time that this bubble starts pricking. And when that happens, the question is, who is going to have enough manufacturing capacity in the world for what we need? That's the question. So as a European, I think we need to think this through, because we can not only depend on manufacturing that might no longer be there, because China will not be able to continue with huge capex on green tech forever, because the returns won't be there. So that's what I wanted to share before we move to the presentation. I will be brief because I'm not sure you can hear me well. At least I have the impression that the connection is poor. Next slide, please. So I just have a little bit of short term, long term. I will try to avoid repetition on the stimulus. So I might jump a little bit to not to bore the audience. Next slide. Next one. So in this slide, I want to agree with that one, that yes, the real estate is very important in understanding what has happened so far, because you can see there how negative housing price growth has been. There's a wealth effect, although it's not so much about leverage of households, but mostly about wealth effect, negative wealth effect. So it is relevant, but it's not like the US in 2008. I would not dare argue that China's low consumption is explained by the real estate sector. There are other reasons for China's very, very poor consumption trends. Next. And in fact, you can see here that when you look at China's household expenditure, everything is going down. It's not only related to the real estate. So you have really very, very low retail sales. September was a little bit better. There are doubts about September data, to be frank, but overall it is still very, very poor. Next slide. And again, not sure if the worst is yet to come, because we have this stimulus. But without the stimulus, I would argue that the worst was going to come. And that is, of course, balance sheet recession for companies repaying debt, households repaying mortgages, because the rates were, as Dan Wang was saying, very high. I mean, I just know of people with fixed rates for their mortgages in China. I mean, all the way to 4.55, and that is really very high because you have deflation. So in real terms, is very, very high rate. So clearly, China's deflation is, I would say, not yet necessarily affecting the consumer, but could have been the doubling down effect to have protracted low consumption in China. So again, probably the stimulus is there to avoid the worst, where we are not yet. And I think basically the authorities probably realized that it was going to come pretty soon. And this is also the case for producer prices. We had, we are still on the negative territory. And I think if you look at even export prices, I think very well depicted in the BIS annual report back in late June, you can see that first half of 2024 close to minus 10%. So you can see that it's impossible to compete with a country that has such huge negative export prices. The exchange rate doesn't even matter anymore, because not that it was very strong anyway, but it is indeed a worrisome issue, because China, to export its way out, it really has to cut prices beyond the deflation from negative producer prices, well beyond. We're talking about more than three to four times worse for exports. And why? Because that's where the margin is. If you talk to any company in China, they will tell you no margin in China. We need to go abroad. And I quite agree, Europe is the market, because this is 55% of EV markets. Any green tech, I mean, it's very hard to export anywhere else. So we are the market, and export prices are there to cheapen the goods so that they are accepted. And no tariffs can stop that. But let's be very frank, because the margin is still so much bigger in Europe than it is. Than it is. I need to turn off this. Than it is anywhere else in China, or frankly even elsewhere, because tariffs are much higher in many other places in the world, including some emerging economies. So we are still the sweet spot. We need to realize that, we Europeans. Next slide. And yes, we know what happens with all of this. China has a very large trade surplus. You don't see it in the current account for reasons that everybody understands. I'll show you in a minute. But the key here is that it's not only about strong exports, it's about weak imports. Both things are happening at the same time because of import substitution, China moving up the ladder, you name it. Next. Now, I did mention that the key for China's competitiveness today is really deflation, more than the exchange rate. But altogether, you can see that China has gained around 15 percentage points of external competitiveness as measured by the real effective exchange rate. It's huge. And it's staying there. It's just not bouncing back. We've been, in this situation for nearly 2 years. And I doubt it will bounce back massively. Of course, it will improve because we don't have the inflation we used to have. But, China, especially if Trump comes and imposes 60% tariffs, they will use exchange rate, in my view, because they cannot lose this competitiveness. They already have overcapacity. Why would they? Next slide. So, as I was saying, don't focus on the current account. I mean, there's many things you may have read about Brad Setzer's idea that, China is manipulating the current account. They don't need to manipulate the current account. It's actually the case that China's imports of services through tourism, but also, double counting of royalties. I mean, all over-invoicing, under-invoicing of imports and exports. I mean, all of that together, especially the first two, which do affect the current account and not the trade balance, are explaining a much smaller current account surplus than the trade balance will show. These are all unrecorded outflows, nothing but that. And it's not that China likes them, it's that they can't stop them. So this is why the current account surplus is smaller. And frankly, we don't see much of a change because foreign direct investment is plummeting. You see the growth rate there. Portfolio investment, this is a bit tricky. It's a little bit better, but a lot of that is actually rechanneling Chinese overseas investment coming back, portfolio investment coming back. So you can see, U.S. Treasuries at the record minimum holdings by Chinese, etc., coming back. A lot of that is, of course, managed. So it's not that it's voluntarily coming back. But you still have a negative financial account in a nutshell. So That's what's happening. That's why China is not really accumulating foreign reserves, even if they have a big trade balance, trade surplus. Next. So now, absolutely, fixed asset investment is as big a problem as consumption, except for manufacturing. So infra, for investment in infra is below GDP growth, and let alone real exchange rate. The real estate sector. So all of that means that the only thing you can do the only place where you can invest in China is manufacturing, according to this data. At least this is how people probably read it, because this is the only thing they're doing. And that builds the bubble I was talking about. Next slide, please. So stimulus. Can China do more? Why did they wait so long? Why can you have yesterday industrial profits minus 27 in September? How do you end up there without enacting or stimulus? Why so late? Well, because it's not so easy, because the times where China could just do it, like whatever it takes type of moment, are gone, are long gone. China has 100% of GDP public debt. We can't really consolidate the fiscal deficit, but augmented fiscal deficit, including local governments and their financial vehicles, of around 11%. So what do you do with this? You have a huge structural deficit. So this is why China finds it very difficult to stimulate the economy. Next. On the interest rate side, which is where the PBOC has started, of course not fiscal yet, it was very difficult until the Fed started cutting rates. And guess when they started? Right after. So I do think this is a constraint. And I do think that if the Fed were to stay put, which is unlikely, but some people argue that there will be no landing and that the Fed will be much tougher than we think, I think China will have a very hard time in cutting rates aggressively, as expected within this stimulus package. Next. And this is because of the RMB, because of banks' profitability, etc. Here, just very quickly, we calculated the amount in GDP terms of the monetary stimulus, banking, monetary, macroprudential, lowering, down payments, you name it. You've heard a lot about this, so I'm going to move on because I really think this is too long, especially online. So next slide, please. Next slide. Yeah. I just want to say that you've probably heard where we stand with the stimulus. We don't know yet until the MPC meets next week, but we've heard the Ministry of Finance, and they've talked about three things. I call that rescue package, not stimulus. I can call it risk management package, financial stability package, you name it. But that's what it is. Three things, as I mentioned before. Buying unfinished units from in the housing market, hidden debt by local governments, and recapitalization of banks. We did estimates. This is very long, but I just want you to know that if you look at the far right, is there something called government acquisition price from market price. So we estimated how much would need to be spent, the government would need to spend to buy the unfinished units. And depending on how much they pay for them, we estimated 70%, which would make developers kind of break even without additional defaults. That would be 3.3 trillion RMB already. There is a number circulating, 4 trillion, but that number, it's a long story, but just to say that this includes refinancing of developers' debt. It's not necessarily only acquiring housing, unfinished or unsold housing. But you already have a sense of the dimension, yeah? We heard 2 trillion. That's the aperitif, basically. 2 trillion is nothing for the size of the unresolved losses. That's just the real estate. But if we move to local governments, next slide. I'm not sure if I sent the calculations because we were still calculating when I sent this presentation. Next slide, please. Yeah. No, I just wanted to Yeah, there's another calculation here to give you the sense of the dimension. Before I talk about local governments very briefly, is that the stance, the fiscal and the monetary stance for that matter, before they cut rates in late September, was tight, not lax, tight, independently on the structural fiscal deficit I showed you, 11% of GDP. But because it's structural, not cyclical, the point is on the cyclical side of the fiscal balance, China was actually tight. And we estimated that they would need 3 trillion RMB to make it kind of balance, given the cyclical situation. So just a sense of where we stand is crazy. Is really, why was it so tight? Because the fiscal authority was worried of letting the local government spend more because they didn't have any revenue, and it wasn't clear whether that situation could be sustained. So it has been, I would say, a financial stability concern for quite a while, but it has taken time to react. Next slide. Bear in mind, and I think we heard this, and I fully agree, that this stimulus, beyond the kind of containing the tail risk, it's also a kind of prop-up stimulus. I would call it rescue package with a prop-up of a stock market, which, by the way, is a very easy or a very useful way to reduce a tail risk in the financial sector. Yeah, because valuations, if you look at Chinese banks' valuations, I mean, some are 3 to the dollar. I mean, it's like 30% to the dollar. So really, really, really terrible. And I think the government realized that they had to prop up the stock market, that there was no way they could prop up the housing market, or at least, stabilize it without propping up the stock market as well. And that's where we stand. And this is very important for state-owned banks and for SOEs. They need better valuations. They can't go anywhere with these valuations. So we need to realize that Chinese companies have, disappeared, some of them at least, from the Fortune 500. And that's based on revenue. Imagine if you base it on stock market capitalization, they're nowhere to be found. So, this is a big issue. Next. Now, by the way, the propping up of the stock market for once, different from 2015, is conducted by the PBOC itself. This is literally balance sheet money from the PBOC. You can call it QE. Nobody likes that name, especially in China. But frankly, this is what the BOJ was doing, buying the index. In this case, it's a bit different. These are two funds. It's not exactly the same. Maybe it's hard to call it QE. But the point is, it's central bank money. And frankly, I think much more will come from the central bank than we think, because China is not ready to see its public debt to GDP reaching 120%. So watch out, because the central bank will be busy. We heard that the central bank is the weakest ever. Well, there you go. It will be weak and busy. That's what it will be. Next slide. I will just move very quickly to the long run. Next slide. I really don't want to be too long here. There you go. So where are we heading? What does this mean for Europe? The stimulus is a good thing. At least it cleans up. At least the deflationary pressures will not be as strong, at least on the upstream sectors. And hopefully somebody will come to their senses and they will reduce this aggressive competition in the manufacturing sector. But that is not guaranteed. That's nowhere to be found for the time being. We only know that subsidies are being reduced, but it's because of the lack of money, not because of intent. Different. But as we move on, for Europe, what matters is, okay, at least no financial event, no major tail risk. I think they're going to manage to do this. That's already very, very positive. We don't want to be in January 2016 with global stock markets collapsing because of China. So that's the good news. Now, if anybody thinks that the stimulus is going to lift up China's growth rate forever, sorry, I have bad news. No way. No way. China's structural deceleration is bound to continue. And this is because the factors behind are so structural that it's very hard to stop them, including by massive investment in R&D. It just can't stop the deceleration. Can mitigate it slightly, but not stop it. Next slide. So overall, we need to think of China growing around 2.3% by 2035. And by the way, I mean, if I were the Chinese authorities or leadership, I would sign up for this. I would just sign up. Guaranteed, I would be happy. Because these numbers do not include aging in the sense that, next slide, in our calculations, we think that actually demographics are still, next slide, please, contributing to growth until 2035. Why? Because of urbanization, which was pushed in the third plenum. And that's the violet color there. I don't know if it's violet anymore, but so basically positive contribution of the labor force to growth because in the productive areas, the cities, you still have people coming in, not in the rural areas. But from 2035, when the urbanization rate hits kind of steady state, maybe 75% or so, every single person who is no longer there hits the labor force in the cities, and you need to bring down growth from 2.3%, which I mentioned to you before, to 1. So in other words, China will be Japan growth-wise by 2035. And we are 11 years to go. That's it. Is this a bad thing? It depends on what you do in China. If you are an SME selling, I don't know, elderly care, you're fine. Other things given, because I'm not talking about national security law, Just imagine everything is clear on that front. And we only talk about the market. And you have market access. All of those hypotheses, you're fine. But anything that is growth-driven, you're not fine. This is a big Japan, where competition already now is probably bigger than Japan in the 90s. So imagine by 2035. So the opportunities are there, but you need to really know what kind of China you're aiming at. And that would be my conclusion. Next slide. I think just to say that when people say, okay, but China can innovate its way out. Well, I have to say, maybe. But so far, we don't see it. Total factor productivity is actually coming down. I have actually more recent data is even worse. And as you can see, the country out there that is investing in R&D more than anybody else is the US, not China. I'm sorry, but that's what it is. I just finished a report on global value chains, and I was shocked to see that up to 2022, which is EORA's kind of private data, the US has picked up in terms of global value chain more than China, the growth of value added. So, not that it matters for China's growth, what the US does, but this is strategic competition in technology. So it does matter in a way. Eventually, it does matter. So to conclude, I think what I want to say, next slide and finish here. Next slide, please. Yes. So somehow there's no conclusions. I did write them, but they disappeared. The good thing is I think I've already told you most of it. The stimulus is welcome, but it won't create growth. Our growth rate for next year is 4.5. It used to be 4.2. So the difference is 3 decimal points of growth. Yeah. And actually the IMF is there too. So it's really not a big deal. But it is good news because it avoids bigger problems. That's where we stand. Does it change the long-term projection and long-term prospects for China's growth? Not really. Not really. To change that, we would need major structural reforms, which we're not hearing from, whether it's on the education system, whether it's most importantly SOE reform, privatization of the banking sector, you name it, governance reform. I mean, all of that. It isn't there. So for me, China is an opportunity for European companies, sure, but you need to know what you're going to do there, because in 11 years, China's growth rate will be similar to Japan. And Japan offers opportunities, but they are different from a growth market opportunity. And therefore, as I said, and this is last time, watch out for what you want to do in China, choose the right path for an economy that is basically decelerating structurally. That's it.
Thank you very much, Alicia, for your sharing. And then please stay a few more minutes with us for the Q&A session later. Without further ado, I would like to invite our third speaker to the stage, Mr. Jacob Gunter, lead analyst economy for Merrick's. Jacob, please take the floor.
Okay. For the sake of time, I'll try to cut everything that has already been said, because a lot has been said. And it's the advantage of going last after two brilliant colleagues. So before I jump into the slides, I'm going to try to kind of pull back to help give people a better understanding of what I think is happening in the leadership in China and what they're actually trying to achieve with their economic policy. Because if we can understand their goals and the means that they're willing to pursue them, that gives companies and policymakers here in Europe a much better understanding of how to anticipate what may or may not be happening next. So very critically, Xi Jinping thinks about the economy not so much as a place of opportunities, but as a place of risks that must be managed. That he has inherited a whole series of different risks internally through sort of the failures of reformers of previous generations to deal with things like real estate, the real estate bubble, to deal with local government debt, and also to push through the structural reforms to maintain kind of strong long-term employment. So Xi Jinping often talks about managing these domestic and internal risks. So that's sort of the domestic half of what's driving a lot of economic policy making and a lot of the trends that Wang Dan and Alicia have outlined. The second major kind of risk mitigation is to prepare for prolonged conflict with the West, with the United States and with its allies, that China sort of assumes Japan, Europe, Korea, Australia, Canada, etc., will sort of move along in the direction that the United States is moving. So these are external risks that must be mitigated, and the main ways to mitigate those risks is through closing the technology gaps. The tech war is the central kind of point of this conflict at the moment. The more the US does to try to restrict technology flows and technology access to China, the more worried the leadership in Beijing gets, and therefore the more willing they are to pour all of this money that Wang Dan and Alicia have mentioned into industry and technology innovation and industrial upgrading and expansion of production. So technology is a huge central point of Xi Jinping's economic policymaking, and closing those technology gaps to remove that risk, because if they can catch up in enough of these technologies, then the United States and its allies cannot contain China, technologically speaking. And then, more broadly speaking, it's also about diversification of supply chains and of export markets. Beijing hates how much it relies on places like Canada, the United States, and Australia for commodities, and it hates how dependent it is on the US and Europe for export markets. So it's aggressively trying to diversify. That's why we have the Belt and Road Initiative. That's why we have a lot of outbound investment going into countries outside of sort of the G7 and friends. So with that thinking in mind, what we see is all of these imbalances that Wang Dan and Alicia have mapped out. We see massive increases in investment into production, and we see suppression of household consumption and household growth, and a suppression of the expansion of the middle class. That doesn't mean there's not going to be a large middle class for a lot of SMEs to still sell a lot of high-quality European goods to, but maybe you can't anticipate the kind of middle class expansion that has historically happened over previous decades. And basically, this is all kind of an acceptable cost in the top leadership in Beijing as a recognition that we are entering a period of extended struggle, and we're all going to have to, as they would say in Chinese, eat bitterness on the path to getting through this protracted struggle with the United States and its allies, and then eventually we can achieve our broader goals of prosperity and the great rejuvenation of the Chinese nation by 2049. So with that kind of bleak picture, let's jump into this. I'll skip over these because one of these charts was quite literally presented by Wang Dan on the consumer confidence. But consumer confidence has been suppressed, and it's remained suppressed, despite that little blip coming out of the zero COVID era. in kind of the end of 2022, start of 2023. There are pretty high expectations about an announcement of stimulus coming up, theoretically on November 8th. Maybe we can get into that in the Q&A. I'm curious to hear what others think about it, but I have pretty low expectations. Again, as others have indicated, growth is increasingly driven by investment into production and exports and things like this, all while real estate has been suppressed. Quite shockingly, the resources that Beijing does have available to itself are basically going towards, again, domestic de-risking, so deleveraging local government debts, winding down the housing bubble, maintaining a baseline of employment. And then the rest of the money is going towards these technology and sort of supply chain diversification efforts, which includes a lot of import substitution, which is one of the many reasons we see this massive spike in fixed asset investment in manufacturing and in new equipment. Now, all of this is happening at a time where we see the tolerance for loss-making companies in China has steadily climbed back up to what it was sort of in the pre-big market reforms and WTO accession in the early 2000s, where you can see in this chart on the right, in the blue line, we see a steady decrease after WTO accession and the Zhurongji era market liberalization, down to about the time that the current leadership takes power. And then a very small, slow, steady increase, and then obviously it sharpens quite a bit with COVID. But nonetheless, we are returning to a period of time of tolerance of loss-making being the norm for a lot of companies. And that's made up with cheap loans and subsidies and the industrial package, or the industrial policy packages that Beijing unleashes. The key difference is in 2000, it was a problem for China when it had huge shares of loss-making industrial enterprises. This was bad for China's development. It was bad for Chinese producers and consumers alike. It didn't really impact the world because China made up about 5% of global manufacturing. Now that China makes up 30% of global manufacturing, this return to tolerance of loss-making is going to have huge spillover effects on the rest of us. I'll kind of skip through this because, again, a lot of this has been covered. I'll kind of focus on that last point, though, that this continuous investment in production and the lack of meaningful and sufficient expansion of household consumption is creating conditions for basically one of three things to happen, and those things can happen at the same time, which is basically import substitution, which again is a stated goal. They want greater self-reliance on technologies, and they want to rely less on American and European technology imports, which means fewer exports from a European perspective. It could be that a lot of production is going to warehousing, but there's not enough space and there's not enough evidence to suggest that that's absorbing much of it. And the rest is going to be through higher exports, especially as Alicia pointed out. There are fierce price wars happening in China in a variety of industries. No one can make a profit off of any units that they're selling in China. So they're looking at Europe in particular as sort of the last big, rich, open market. I won't go, again, too far into the ideology aspect, but I know when we here in Europe think about the ideology of the Chinese Communist Party, we don't really think so seriously about it, but we really should. Because quite often, if you basically read this thing called Qiushi, which is sort of the theory journal of the Chinese Communist Party, they will often very clearly map things out, like months or years ahead of time, about the direction that economic policy making will be going. And the reason I bring these up is Wang Dan already covered this idea of new quality productive forces, the obsession with catching up in technology and industrial policy to unlock new growth. But importantly, Xi Jinping often talks as well about how these new quality productive forces, quote, does not mean abandoning traditional industries. So we cannot expect that China will go through the same kind of economic transition as it climbs up value chains that other countries have historically gone through, where as China climbs up global value chains, the lower value part of the value chains flow out to other markets. There's some of that happening, but not nearly as much as should be happening. And a lot of that comes down to the policymaking and the ideology of the CCP, which is quite literally holding on to the industrial heights of the economy and maintaining that economic base for political purposes as much as anything else. And all of this matters immensely because we're going through this important transition We stop hearing about it, but it's still really important to understand about policymaking. This chart on the left is the transition between the traditional economic model to the model proposed by Xi Jinping in 2020 of what they call dual circulation strategy. That China historically, its development was driven by plugging itself into the global economy. That Deng Xiaoping and Jiang Zemin sort of said, we don't have natural resources in abundance, we don't have technology or capital, what we have is a huge labor force, and we will plug our labor force into the global value chains, import high technology and capital and raw materials, use our manufacturing base to pump out finished goods, and that will be the main driver of growth. This dual circulation concept that Xi Jinping has is basically that as China will climb up the value chains, it will no longer just be exporting kind of finished consumer goods, but also an exporter of technology, an exporter of capital, an exporter of high-value goods. And it will become less reliant on importing that capital and those technologies. The problem is the second half of this equation, which is that China's domestic consumption needs to grow so that, as they call it, an internal circulation is the main driver of the economy. And China would become less reliant on exports. And that has not happened. So the drive for import substitution and for climbing up value chains and technology self-reliance has made a lot of progress. The idea of creating an internal engine for growth has not happened. And what's critically important about that is, again, those goods that are being produced need to go somewhere. And if they're not going to be consumed by an ever-growing Chinese domestic market, they will need to be exported. And again, you can see on the right, those exports have massively increased. And to kind of close off, I wanted to make things a little bit more tangible. Sorry, I'm not sure why the formatting messed up here, but it works well enough. That specifically thinking about this from the perspective of European companies, and thinking about the opportunities and the risks of entering the China market, it's important to understand where you fit into this policy sort of framework and situation. So as foreign companies have significant roles to potentially play into this technology self-reliance drive, into this drive for climbing up global value chains. In an ideal world, I think Beijing would like nothing but indigenous local companies to fulfill all of these goals. But in the meantime, they're quite happy to attract a lot of foreign technology providers to bring them into the China market, help them do business, and go through what we call this technology attraction phase. I'm not going to go through all three examples, but basically that you have a technology attraction phase to pull the technology in, do a lot of good business for those foreign companies, and then master the technology within China and localize that production, which also makes it harder for the Americans to cut off access to that technology. But then over time, as Chinese companies catch up by being around the technology, it's not just through technology transfer, it's also that just being in the same ecosystem helps bring up a huge amount of innovation. Local brands become kind of good enough in these strategic technologies. And then we enter what we call the home market consolidation phase, where there's really, really fierce competition. And local companies will have the government behind them in strategically relevant technologies. And the idea is to try to preserve market share for the local brands and help them maximize their revenue so that they can then use that revenue to finance their own R&D and go from good enough technology to globally competitive technologies. And that's where we enter the third market expansion phase, where Chinese companies increasingly are going overseas once they have become really, truly not just good enough, but really, really competitive at home. They're going abroad, which makes sense. Of course they would. They'd be stupid not to. The reason I bring this up is this is an old story with high-speed rail. This is basically becoming an old story now with telecoms equipment, specifically with 5G. If you go back to the 2G, 3G rollout, these companies like Huawei and ZTE, they're kind of interesting new names. Now they have almost complete market share in China and huge amounts of market share globally. This is happening increasingly specifically with EVs. There are a lot of medtech sectors where we see they're kind of at the early to mid stages of this. A lot of industrial machinery, and this is where a lot of the SMEs in Europe come in. That the stories of like the big companies that cover things like high-speed rail and telecoms hardware and software, those are maybe having less of an effect on European SMEs. But as we get into medtech, pharma, industrial machinery, high-quality components that are made by Mittelstand-style companies, these are very much targets of Beijing's industrial policy. And again, when you're in these kind of early to mid phases, there are huge opportunities in the China market. But it's really important to monitor where your company fits into this kind of strategic picture and where it sits relative to Chinese industrial policy and your Chinese competitors. And then, over time, how do you think about how your China strategy relates to your third market and your global strategy to compete with Chinese companies overseas? And as a closing note, because this is an SME-centered event, or an SME-focused event, there's an entire separate part of Chinese industrial policy. There's this thing called the Little Giants Initiative that is entirely based around trying to replicate the high-tech EU SME model. Instead, they're doing it top-down instead of bottom-up to kind of oversimplify it. But nonetheless, this is one of the really important parts of industrial policy under Xi Jinping, is this is no longer just about supporting the big SOEs and supporting the big private companies. If small companies in China can prove and demonstrate that they have or are planning to kind of develop the technology that Beijing wants, there's huge support mechanisms available for them. And again, that's going to create interesting opportunities, but also a lot of competition risks for SMEs in the market. So I hope I haven't depressed people too much, and I hope I didn't go through things too quickly, but I wanted to make sure we could save at least a few minutes for Q&A.
Thank you, Jacob, for your presentation. And can I invite Dan back to the stage to join the Q&A session? And can we also have Alicia connected? Shall we see Alicia? Okay, now we see Alicia as well. I would like to already open the floor to questions from the audience we have today in the room, but also from online.
Hello, thank you. Unfortunately, I missed part of the Alicia's presentation, but I think it was I hope it was not covered the question, but also Dan, what you were saying. So you were saying that actually the banking system in China, it was more than 4,000 banks, and it's hugely dominated by small. There are a lot of small banks, local banks, regional banks, which actually was the case also in Europe with Sparkassen in Germany or Cassa di Risparmio in Italy. And they were actually very important for the development of the SMEs in Europe because they were local banks with the local directors that knew that that guy was a good guy coming from good family, and I will give him the money even if the business plan is whatsoever. Nowadays, with Basilea and whatsoever rest, we have basically completely changed the landscape of the business in Europe, banking business in Europe, with fewer but big banks present. So there might still be present locally, but basically these local banks are owned by big banks. And when they have to give the loan, basically, when I interview them, and they always say yeah, I would like to give the loan, but there are all kind of red lights coming, green on the screen. A second chance, oh, you failed once, no way I'm going to give you. Whereas I know that maybe the entrepreneur is a good one and potentially will bring back money to the bank, which is the ultimate. So from this perspective, what is the situation in China? Are they trying to incorporate these smaller banks into bigger banks, so having a bigger leverage, a much more systematic situation, or the smaller banks are there to keep existing?
So I would say Europe's present is China's future. So there's been a huge consolidation effort since 2 years ago. There were several regional big banks were created on the provincial level, on the sort of like on the state level, and they were absorbing, consolidating the books of several regional smaller banks that are already in trouble. And this process would take a long time because what they have to do now, of course, is to provide more liquidity to the smaller banks, but everybody faces the same problem. They cannot find good clients. So regardless where you are, maybe the bigger banks can delay the problem for a while, but they cannot resolve it. That's number one. And number two is, right now, of course, the national strategy is to prioritize SMEs. But the fact is, in China, without a housing or some other equivalent collateral, nobody can borrow from the bank. That's the thing. You need collateral. And for mid-sized, smaller micro businesses, it is only housing. And housings are losing value like crazy. Comparing to the peak in 2021, now the average housing in China is 60% down. 60. So with that valuation, banks dare not to lend to smaller borrowers unless they have some sort of guarantee from the local industrial association or indirectly from the local government. You have to be in the right industry, you have to have the right kind of endorsement. So that essentially made SMEs, this whole sector, shrinking. So now the only way to survive is to become a supplier for a big POE or a big SOE. So that's the way out. And the third point I want to make, also the last point, is that banks do lend to SMEs in China. Smaller banks cannot compete with the bigger ones because the bigger ones has the capital advantage. They can lend out at a much lower rate. So they now actually, this new trend is that they're getting into smaller cities, smaller counties, competing directly with the local smaller banks. And they're making the situation worse. They're not really making it better for the capital access.
Check, check. One very small addition to that is a lot of these Chinese local banks are very, very different from the European local banks that existed historically. Specifically that local Chinese banks, overwhelmingly, almost all of them are like state-run, state-owned, usually by local governments, and they are attached at the hip, as Wang Dan said, not only to the local housing market and to local government and local debt, they're also very often attached at the hip to local state-owned enterprises that are actually producing things. And these are not the big strategic SOEs that are producing important technology at the national level. These are like local cement and steel companies that don't make a real profit. And these banks exist basically to be a financial vehicle for dealing with like local government debts, local housing debts, things like this. They don't have the kind of mandatory like demands for return on investment that like a small town or a small state level bank in let's say France or Germany would have. So they're two very different beasts altogether.
Alicia, do you have anything to comment on this question?
I want to add the following. While it would make sense to imagine that China is moving to our type of banking sector, I think it's not going to happen. And the reason is that first, these banks need to be recapitalized. Even the big banks have to be recapitalized. There's also already rumors of 1 trillion RMB to be put by the central government, maybe through, like in the past, Huijin, or maybe the arm of the PBOC with foreign reserves. We don't know who is going to do it, but it's 1 trillion RMB just for the large state-owned commercial banks. Imagine the others. We finished a report looking at financial stability and the amount of capital needed. Large banks, according to our calculations, needed a lot for TILAC because they still have not raised TILAC in China. They have not even started. But smaller banks are much, much worse. They're not generating any organic capital. The profitability is very low. So they cannot move there because they cannot enforce the same regulations that we have in Europe, because that would be a killer, really. And therefore, I think they will be servant of the local governments to help with the execution of the stimulus. They will get some money in exchange for loans to support the stimulus. So I think in that regard, I don't know what this means for our European SMEs. Will it be harder? I don't know. But I think It's not about credit scoring and it's going to be much of the same, but harder, because they will need to raise capital from the local governments to survive. Yeah.
Thank you. And we have one more question from the audience.
Yeah,
Massimo?
it's just to follow up on this topic and share a piece of information coming from the field from China. Recently, along one public event organized by the European Chamber of Commerce, we were approached by a local bank from Zhejiang province. You may know it's one of the richest provinces in China. And they said, we are willing to finance also foreign SME. And so I asked them the typical question. So do you need a physical asset? No. The requirement of having a Chinese legal representative? No. What do you need then? And they said, we need a reasonable pipeline of contract and a kind of a healthy, status of the company, even if it's very small and so on. I do believe then they will look into the sector. Of course, they should have some, security is not there giving money around, but it's something that we may explore and see in the future if can bring anything positive. Thank you.
We have one more question here.
Sara Medina from SPI Portugal, one of the partners of the EU SME Centre project. Thank you so much for the excellent presentations, really, really very much appreciated. I have a question regarding the SME's attractiveness. In terms of, if we compare the different cities in China, the first-tier cities, second-tier cities, third-tier cities, do you see any changes and any specific trends in terms of attractiveness of foreign SMEs? Thank you so much.
So I'll invoke my former position at the European Chamber of Commerce when I used to work there. And a lot of the work that I've done speaking with companies on the ground across China in recent years echoes the same thing, which is if you're a foreign SME and you're trying to enter like Shanghai, it's going to be really difficult to get the kind of support that you're looking for because there's so much demand for it. There's so many high-tech Chinese companies, including SMEs, that are crowding out the space for a lot of the different incentive packages that exist. So you have things like the HNTE status, the High New Technology Enterprise status. It's really difficult as a foreign company to get this in general. It's a lot easier to get it outside of the big cities because basically local officials will have more flexibility when they are outside of the bigger cities and they need to attract high-tech companies and high-tech production. And a similar thing happens with a lot of support in like industrial zones and high-tech zones and things like this that might be quite attractive to some SMEs. There's just so much demand in big Chinese cities. So go to the smaller places, you'll find a lot more flexibility and find a lot more support in general.
I'll just add one case, because I've recently talked to a few of the, I don't know if it's that small, but mid-size European and American companies manufacturing, trying to establish a new factory in China, mostly around Shanghai, Suzhou, that region. They cannot find a industrial park that is willing to take them in because they're too small. Considered by Chinese standard, they're just too small. And for those officials, they'd rather take in like a Chinese company that are not so good but big. They want scale, so they will minimize their trouble accommodating a foreign small company, without much of a skill factor or employment. So that's like I think it has a lot to do with the incentive scheme with the current official system, but also it just reflects the status of the Chinese economy right now. People are trying to avoid troubles, avoid risks, rather than seeking opportunities. Yeah.
If I may add just a small point, I don't think it's so much tier 1, tier 2, tier 3 cities. It's more about which sector are you in? What can you bring to the table? Are you ready to localize, no matter the size, with the related costs of localization, and do you have patents? That's what it is. That's what it is. So if you localize, you can go to the tender. So if you are, for example, a very, very successful sector in the sense for European SMEs is, of course, medical devices. Yeah, but you go in, you surrender basically your technology, whatever that might be, plasma. I can give you many examples. You start creating the ecosystem in China. So somebody does what you do, maybe first as a supplier, then as a competitor. There you go. So it's a nice ride. The question is, how do you stay there? So if you have something that China needs, you'll find the industrial park, no worries. But you need to have something that China needs and be ready to share it. That's what you need.
Yes, we have more questions from the audience.
Yeah, hi, thanks. So it's Wang Yuan from Carbon Brief. A quick thank you for Alicia for helping me when I was a journalist at the BBC, and a quick thank you for Jacob for helping me for our EVPs this time. And so my question is really for a concept that Ms. Wang Dan has mentioned in your presentation, which is why the federal government cuts the interest rate is so important and difficult for the Chinese. Thanks.
The Federal Reserve cutting the interest rate, because one concern from the central bank, actually their primary concern is about price stability. And that price stability includes two aspects. One is a domestic price, that's inflation. We don't have a problem in that regard. It's basically deflation. But then when it comes to foreign price, that's the foreign exchange rate. So there's a worry that Chinese yuan might under bigger depreciation pressure if China cuts interest rate too drastically without the U.S. lowering its rate first. So this fear has been there for the past 2 years, and it has become more prominent over time. And in terms of the capital flow direction, it's also the case. Of course, Chinese economy is not doing well, but it's not so risky that everybody has to take their money out. A very big driving force is basically the interest rate difference. It's so much higher interest return, like the risk-free interest return in the U.S. has been like 5% for the past 18 months, and in China it's practically zero. So anyone in their right mind should move as much money out as possible and as quickly as possible. So the Chinese government is also worried if they lower the rates without lowering it, they will cause a capital outflow, basically.
I may add, I agree. It's exactly that. But on top of it, there is the problem of bank profitability. Banks are very important for China. They are the arm of the Ministry of Finance to stimulate the economy, like in 2008. I mean, it's like the immediate multiplier because they are owned by the government. So, if banks are not profitable, it's a big problem. And as interest rates go down, so imagine we didn't have the Fed, just even without the Fed, as interest rates go down, the margin gets reduced, and therefore the banks become less profitable and they don't have enough capital to serve their clients. So so in a way, both the Fed but also the bank situation was kind of keeping the PBOC in control. But now, of course, the Fed is making it easier on the exchange rate, as we heard, and also they're going to recapitalize the banks. So in a way, they can do it because they will help the banks. They need to do it for the economy, i.e., they will help the banks survive even if rates are lower. So bear in mind, this is Japan in the 90s. I'm just telling you. I mean, this is Japan in the 90s. Real estate sector collapse, clean up the banks, recapitalize the banks slowly but steadily. We've seen this before, I'm afraid.
Thank you, Alicia. I'm very happy to see we have so many questions from the audience, but Nelly, please let me know when we should stop. We have online audience joining, so I suggest we try to also respect the time we set because there's another session for this morning. and we are connecting from people with a 7-hour difference. Alessandro, question is.
Good morning, everyone. Thank you first for your wonderful presentation. It was very enlightening, all of you. And I'm Alessandro Zador from Italy-China Council Foundation. We are also a partner at EU SME Centre. I have a question, like very basic question. Just, a lot of small companies come to me and say, is it China a prospective market for consumption? We export there without thinking about localizing, just pure export. You mentioned, like you talk a lot as a consumption, that it should have been more, according to the Chinese plan 2020, circulation more crucial in terms of like domestic growth together with innovation. It didn't happen, and we all know that lots of like Chinese people wealth is linked to the housing sector, and there's a lot of issue regarding the lack of welfare system. So people are not really looking into spend money at the moment, as you show with the confidence going down. So is China a prospective market for consumption? Speaking as an Italian, Italy, an export powerhouse that last year exported over 600 billion euros, but to China only 19, of which 4 or 5 of pharmaceutical produced by a German company in Italy. So is it still a prospective market for consumption or not really?
Yes, definitely yes. So I think there are several ways of looking at it. Immediately, I would consider Chinese households, the actual financial situation of Chinese households. In fact, they are still the most liquid households in the world. And they're about, right now, still 20 trillion RMB of savings in the bank system. Truth be told, they're not all from the additional, saving from the income. So a lot of that was from the liquidation from the stock market. People are still quite worried putting their money back into stocks. And a big portion, probably from the balance sheet that I can't have access to, a big portion, more than half of it, is because people set aside money to buy homes. But the housing market is so horrible. People are not buying homes, so the money just sitting there. It doesn't mean that those money would eventually translate into the purchasing home fund, but in the future, the housing prices will be lower than now. Yeah, so a lot of those money will translate into consumption. And a bigger trend in China now, of course, people are more price sensitive, so they try to save as much as possible, also due to uncertainty about policies, about their job security. But also a bigger trend I can say as opportunity is backwards. It's like lower tier cities, now you create a new business, startups, and it's usually in the premium market of those smaller cities and counties. And then if you do well, you go back to the first tier cities. And a prominent example of that is this retail store called Pangdonglai. I don't know if you guys have heard of it, because my hometown is in a city near Xinxiang. I was born in Henan, so my grandma lives there. So I took a train, went from Anyang to Xinxiang. Pangdonglai was this premium store, grocery store / luxury store almost. We have plenty of those in Shanghai and Beijing, but in a place like Xinxiang, the average income is like 1/10 of that in Shanghai. Like no one would think this kind of place can survive in China, but it did, and it thrived. The average wage of its employees of this store is 4 times of the local competitors. And they also have like a 40-day of like annual leave, something like that. So it's like a very modern management style. And when I visited, it was like crowded. It has been crowded every single day for the past however many years. So it is one example of showing how to capture some opportunities in China. And I believe the current situation probably will last for a very long time if we're really in the Japan situation. But given that, we do have a pretty large middle class segment, and they have purchasing power. Most of them don't have the opportunity to move their assets or themselves out. So they live in China. There is a demand for improvement.
Yeah, just the size of the market in general, the size of China's middle class. I wouldn't count on the middle class to continue growing the way it used to be. So China may not be the kind of growth market that it was for already established European brands that are exporting to China, especially kind of in the higher end and luxury models and such. But even if there was a pretty significant decrease percentage-wise of kind of middle class consumption, it's still such a huge market. And especially for EU SMEs that are looking to kind of enter that market, even if they're not localizing production, but they're just exporting to it, setting up retail and sales offices and such, setting up connections with local retailers, things like that, then it effectively acts as a growth market because you're kind of a new entrant there. So for the established and for the new ones, there's a lot of opportunities there. And most importantly, I would say that for consumer goods, like most consumer goods kind of fall outside of the whole strategic technology aspect that I was covering, and that I think a lot of us covered. That in strategically relevant technologies, which are mostly upstream technologies, they're things that empower entire value chains. These are the main areas of focus of industrial policy and the politicization of business. If you're selling a lot of consumer end goods and kind of downstream goods, in many ways, you're kind of liberated from that. And so, yeah, for a lot of European AFB exports, cosmetics, luxury, fashion, things like this, I think there's still a very large market, and it will probably be one of the last things to go through kind of a politicization phase. And obviously, from like a technology perspective, I can't see U.S. long-arm jurisdiction going after European cosmetic exports to China the way that they might if go after, say, a European SME that produces components for semiconductor manufacturing equipment. So in many ways, consumer goods can kind of fly under the radar of the politicization of everything.
Sorry, is European brand still attractive enough? Because there is a reject of Europe, so is it still appealing?
Yeah, so are European brands still attractive? I'm making sure to mention that so Alicia can hear it. Overall, yeah, I think so. There is the potential risk of kind of a rising nationalism in consumers that will prefer indigenous local brands and such. The thing is unless there's some really major geopolitical crisis, I can't imagine that people that are already sufficiently prone to nationalism to change their consumption patterns would only do so after a small incident. So, like, I don't think the EV tariffs is going to lead to a whole bunch of nationalist middle and upper class Chinese consumers no longer buying European luxury cars. If they were already that prone to nationalism, they probably have already bought like a BYD or a Wangyang or something. But no, Chinese consumers have good taste. They are interested in high quality goods. That Europe has a lot to offer. Yeah.
I would suggest we wrap up from here. Sorry if there are more questions on the floor. Later we'll have a short moment of coffee break. You'll have the chance to continue your discussion with our speakers. Maybe as a wrap-up conclusion or question, I would like to point out that it's interesting, all three of our speakers has mentioned the importance of the EU market currently to China's planning on achieving its achievement of its economic goals. And I quote Dan's comments that it requires some big assumptions. So one of them being that the EU market remains open for China. And the question would be, what if the EU does not play the ball and does not keep the market open for China? What would be the consequences? What would be the revised measures? And I think we could very much leave this discussion later, as for this morning session we have one more speaker, Ms. Eva Valle-Lagares, Head of Unit Far East at DG Trade. And I think after this short coffee break we'll have Ms. Valle on the floor to share with us from the Commission's perspective on EU-China trade relations, its outlooks, and what's to come. Before we go to the coffee break, I would like to suggest a big round of applause for our speakers, Dan, Jacob, but also to Alicia from online.